A financial earthquake is shaking the foundations of the American economy, and precious metals are flashing bright red warning signs that something catastrophic is coming. In just the past 3 weeks, 18 major U.S. companies with liabilities exceeding $50 million each have filed for bankruptcy protection. That's the fastest pace of corporate failures we've seen since the pandemic, and eerily similar to the levels witnessed during the 2009 financial crisis. But here's what makes this absolutely terrifying. This isn't happening during a recession or market crash. This is happening while the stock market is near all-time highs, and the mainstream media keeps telling you the economy is fine. Gold and silver aren't buying the propaganda. Both metals are behaving exactly as they did in the months before previous financial crises. And if you know how to read these warning signs, you can position yourself to not only survive what's coming, but potentially profit enormously. In the next several minutes, I'm going to reveal which companies are collapsing, why this bankruptcy wave signals something much bigger, and exactly what gold and silver are telling us about the financial storm that's building on the horizon. And welcome back to the channel, and if you're new here, make sure you subscribe and hit that notification bell because we're covering critical financial developments that could determine whether you protect your wealth or lose everything in what's coming. Today is February 13th, 2026, and I need to talk to you about something that should be front page news on every financial website, but is instead being buried and downplayed by mainstream media. We are witnessing a bankruptcy crisis that is accelerating at an alarming rate, and the implications for the broader economy and for precious metals investors are absolutely enormous. Let me start with the headline number that should shock everyone. Over the past 3 weeks, 18 U.S. companies with liabilities exceeding $50 million have filed for bankruptcy protection. Now, you might be thinking that bankruptcy is just a normal part of business cycles, that companies fail all the time, and that this isn't necessarily cause for alarm. But you would be completely wrong. The pace and scale of what we're seeing right now is anything but normal. This is the fastest rate of major corporate bankruptcies we've experienced since the COVID pandemic in 2020, and we're approaching levels that we last witnessed during the depths of the 2009 financial crisis. To put this in proper context, during normal economic times, you might see 3 to 5 companies of this size filing for bankruptcy in a given month. Maybe 6 or 7 during periods of mild economic stress. But 18 companies in just 3 weeks? That's not normal. That's a crisis. And what makes it even more concerning is that this is happening at a time when the stock market is trading near all-time highs, unemployment numbers appear relatively benign, and the Federal Reserve and Treasury Department keep insisting that the economy is fundamentally sound. So what's really going on here? Why are so many companies suddenly unable to meet their financial obligations? The answer lies in understanding the delayed effects of the interest rate hiking cycle that the Federal Reserve implemented over the past few years. Starting in early 2022, the Fed began raising interest rates aggressively to combat inflation. They took the federal funds rate from near zero all the way up to over 5% in a relatively short period of time. This was one of the fastest and most aggressive tightening cycles in modern history. When interest rates rise, companies that carry significant debt face a brutal squeeze. Their borrowing costs increase dramatically as old debt matures and needs to be refinanced at higher rates. Credit lines that were cheap and easy to access become expensive and restrictive. Projects that made economic sense at 2% interest rates suddenly become unprofitable at 5% or 6% rates. Cash flow that was adequate to service debt at low rates becomes insufficient as interest expenses balloon. But here's the key insight that most people miss. There's a significant lag time between when interest rates rise and when companies actually fail. A company doesn't file for bankruptcy the day after the Fed raises rates. They struggle for months or even years trying to cut costs, sell assets, renegotiate with creditors, anything to survive. They burn through their cash reserves, they tap credit lines, they delay payments to suppliers, they lay off workers, they cancel expansion plans. But eventually for many companies, the math simply doesn't work anymore and bankruptcy becomes inevitable. What we're seeing right now is the culmination of that process. These 18 bankruptcies over the past 3 weeks represent companies that have been struggling for the past year or two, and they've finally reached the point where they can no longer keep the plate spinning. They've run out of options, run out of cash, and run out of time. And here's what should terrify you. These 18 companies are just the beginning. They're the canaries in the coal mine. They're the weakest links in the chain that are breaking first. Behind them, there are dozens or potentially hundreds of other companies in similar situations who are still trying to hang on but are facing the same impossible math. High debt loads, elevated interest rates, slowing revenue growth, rising costs, and diminishing access to capital. It's only a matter of time before more companies join the bankruptcy rolls, and the pace could accelerate dramatically from here. The sectors being hit hardest tell us a lot about where the stress is concentrated in the economy. Retail is taking significant hits as consumer spending patterns shift and overleveraged retailers struggle with high lease costs, inventory challenges, and changing shopping behaviors. Commercial real estate is another trouble spot as vacancy rates rise in office buildings and property values decline, leaving developers and REITs unable to service their mortgage debt. Now let me connect the dots between the bankruptcy crisis we're witnessing and what's happening in precious metals markets, because this is where the story becomes critical for your investment strategy and wealth protection. Gold and silver are not just commodities that fluctuate randomly based on supply and demand. They are sophisticated market instruments that reflect collective wisdom about economic conditions, financial system stability, and currency confidence. And right now, both metals are flashing warning signs that experienced investors know how to read. Let's start with gold's price action over the past several weeks. Gold reached an all-time high near $5,600 per ounce in late January before experiencing a sharp correction that took it down to around $4,400. That crash, which we've discussed in previous videos, was triggered by the Kevin Warsh Federal Reserve nomination and was amplified by forced liquidation of leveraged positions. But here's what's significant. Gold has since recovered to $5,071 and is holding well above the psychologically important $5,000 level despite ongoing volatility in broader financial markets. This resilience is extremely important. In normal market environments, when stocks are making new highs and economic data appears solid, gold typically struggles to maintain momentum. Investors rotate out of safe haven assets and into risk assets like equities and corporate bonds. But that's not what's happening now. Gold is maintaining bid support at elevated levels even as the S&P 500 trades near all-time highs. This divergence between gold strength and stock market strength is a classic warning sign that sophisticated investors are hedging their portfolios against risks that aren't yet visible in headline economic data. Central bank buying behavior is another critical warning sign that gold is flashing. According to the World Gold Council, global central bank gold purchases surged past 5,000 metric tons in 2025 for the first time on record. Central banks are some of the most well-informed participants in global financial markets. They have access to data and intelligence that retail investors will never see. When central banks are buying gold at record levels, they're telling you something important about their level of confidence in the current monetary system and their concerns about future instability. The People's Bank of China has been particularly aggressive, continuing its multi-month accumulation streak without interruption. China isn't buying thousands of tons of gold because they think it's a good trading opportunity. They're buying gold as a strategic reserve asset to reduce their dependence on the US dollar and to protect themselves against potential currency crises and geopolitical conflicts. When the world's second largest economy is aggressively accumulating gold, you should be paying very close attention. Silver's warning signs are different but equally significant. Silver crashed 40% from its peak above $121 down to current levels around $77.62, which on the surface might seem like a bearish development. But if you understand market mechanics, you realize that this crash was primarily a technical liquidation of overleveraged positions, not a fundamental change in silver's outlook. And what's telling is what happened after the crash. Physical silver premiums have remained elevated, coin and bar demand has actually strengthened. Industrial users are securing supply at prices well above spot. This disconnect between paper silver prices and physical silver market realities is another warning sign. It suggests that the futures market, where most price discovery occurs, is being influenced by forces other than genuine supply and demand for physical metal. When paper prices crash but physical demand remains strong, it tells you that the paper market is not accurately reflecting the true state of the physical market. This kind of disconnect has historically preceded major price explosions as the paper market is eventually forced to reconcile with physical reality. The gold to silver ratio, currently sitting around 65-1, is also flashing warnings. This ratio tends to widen during periods of extreme financial stress as investors flee to gold more aggressively than silver. We saw the ratio spike above 120-1 during the March 2020 COVID panic. We saw it reach similar levels during the 2008 financial crisis. The current reading of 65-1 is elevated, but not yet at panic levels, which suggests we're in the early stages of a stress cycle rather than at the peak. Physical metal availability is another warning sign that doesn't get enough attention. Dealers are reporting that while prices have corrected significantly from the peaks, physical supply of coins and bars remains tight, and delivery times are extended. When you can buy paper silver futures at $77, but you have to pay $85 or more for physical coins with multi-week delivery delays, that's telling you something important about the disconnect between financial market pricing and real-world supply and demand. Now let me show you why these 18 bankruptcies are not isolated incidents, but rather symptoms of a much larger financial crisis that's quietly building beneath the surface. When you understand the connections between corporate failures, household debt, banking system stress, and government fiscal challenges, you'll see why gold and silver investors are positioning themselves for what could be the most significant financial crisis since 2008. Let's start with the household debt situation that we touched on earlier, but needs to be examined in greater depth. U.S. household debt now stands at $18.8 trillion, according to the New York Federal Reserve. This includes $12.5 trillion in mortgage debt, $1.6 trillion in auto loans, $1.6 trillion in student loans, and approximately $1.1 trillion in credit card debt. Every single category is at or near all-time highs. But again, it's not just the total amount that matters. It's the quality of that debt and the ability of borrowers to service it. Credit card delinquencies at 12.7% are particularly concerning because credit cards are unsecured debt, meaning there's no collateral backing them. When someone defaults on a mortgage, the bank can foreclose on the house and recover at least some value. When someone defaults on an auto loan, the lender can repossess the vehicle. But when someone defaults on credit card debt, the lender often recovers nothing. These losses flow directly to bank balance sheets and reduce the banking system's capital cushion. The auto loan market is showing similar stress signals. Delinquencies are rising, particularly among subprime borrowers who took out loans during the pandemic when lending standards were relaxed and used car prices were inflated. As those cars depreciate and borrowers struggle with high monthly payments, we're seeing increasing defaults. The problem is compounded by the fact that many of these loans are underwater, meaning the borrower owes more than the car is worth, which incentivizes default. Student loan debt presents a unique challenge because, unlike other forms of debt, it generally cannot be discharged in bankruptcy. This means that $1.6 trillion in student loans represents a permanent drag on the spending capacity of millions of Americans who are trying to build wealth, buy homes, start families, and participate in the economy. Every dollar going to student loan payments is a dollar not being spent on goods and services that drive economic growth. Now let's connect this back to the corporate bankruptcies. When consumers are overleveraged and struggling to service their debt, they cut back on discretionary spending. They stop going to restaurants as frequently. They delay purchasing new cars, they skip vacations, they buy fewer clothes and electronics. This reduction in consumer spending flows directly to corporate revenue lines. Companies see sales growth slow or turn negative, profit margins compress, cash flow weakens. And companies that were already struggling with high debt loads find themselves in an impossible situation where declining revenue meets rising interest costs. The commercial real estate sector exemplifies how these dynamics create vicious cycles. Office buildings are seeing elevated vacancy rates as companies embrace remote work and downsize their physical footprint. Retail properties struggle as e-commerce continues taking market share from brick and mortar stores. When occupancy falls and rental income declines, property owners struggle to make their mortgage payments. Banks holding those mortgages face losses. Property values decline, which means buildings can't be refinanced. Developers can't get financing for new projects. Construction jobs disappear. It's a self-reinforcing downward spiral. The banking system is caught in the middle of all of this. Banks hold the mortgage debt on commercial properties. They hold the credit card receivables from consumers. They hold the corporate loans to businesses. When defaults rise across all these categories simultaneously, bank balance sheets deteriorate. Capital ratios decline. Lending standards tighten. Credit becomes harder to access. This credit tightening makes it even more difficult for struggling companies and consumers to survive, which leads to more defaults, which further weakens banks. This is the classic credit crunch dynamic that characterized both the 2008 financial crisis and the early 1930s Great Depression. Government finances add another layer of concern to this picture. The U.S. national debt is now $38 trillion and growing by more than $2 trillion per year. Interest payments on that debt are consuming an increasing share of federal tax revenue, leaving less money for everything else, including defense, social programs, infrastructure, and emergency response. So after understanding the bankruptcy crisis, recognizing the warning signs that gold and silver are flashing, and seeing how all these problems connect to a broader financial crisis, the critical question is, what should you actually do right now to protect yourself and position for what's coming? Let me give you a clear, actionable strategy based on the current situation. First, and most importantly, you need to accept that the mainstream narrative about economic strength is either deliberately misleading or dangerously out of touch with reality. When you have 18 major companies going bankrupt in 3 weeks, household debt at record highs with rising delinquencies, and gold prices remaining elevated despite stock market strength, you cannot trust assurances that everything is fine. The warning signs are everywhere for those willing to see them. Your first action item is mental and psychological. You need to reject normalcy bias and accept that a significant financial crisis is a real possibility that deserves serious preparation. Second, assess your current financial situation with brutal honesty. How much debt are you carrying? What's your debt-to-income ratio? If you lost your job or your income was reduced by 30% or 50%, could you continue meeting your obligations? Do you have adequate emergency savings? Are you overexposed to risky assets that could collapse in a crisis? Most people don't want to ask themselves these hard questions, but now is exactly the time to do it. If you're carrying high-interest credit card debt, paying that down should be a top priority. If you have variable rate debt, consider refinancing to fixed rates while you still can. If you lack emergency savings, building a cash cushion of 3 to 6 months of expenses is essential. Third, precious metals need to be a core component of your wealth protection strategy. Gold and silver are not speculative investments that you buy hoping to get rich quick. They are insurance policies against currency debasement, financial system instability, and government fiscal irresponsibility. Just as you wouldn't cancel your home insurance because your house hasn't burned down, you shouldn't avoid precious metals just because the crisis hasn't fully manifested yet. The time to buy insurance is before you need it, not after the disaster has already occurred. For most investors, I recommend allocating 10% to 20% of your investable assets to precious metals. This is enough to provide meaningful protection if things go badly wrong, but not so much that you're over-concentrated in a single asset class. Within that allocation, consider a mix of gold and silver that reflects your risk tolerance. A conservative investor might do 70% gold and 30% silver. A more aggressive investor, willing to accept higher volatility, might do 50% gold and 50% silver, or even favor silver more heavily. Physical ownership is critical. Don't rely exclusively on ETFs or mining stocks for your precious metals exposure. Own physical coins and bars that you can hold in your hand or store in a secure location that you control. In a true financial crisis, counterparty risk becomes very real. ETFs that promise to hold physical metal on your behalf may or may not deliver when you need them most. Mining stocks are equity positions that can fall to zero even if metal prices rise. Physical metal in your possession eliminates these risks. For those in India, the options are straightforward. You can buy physical gold and silver from authorized dealers and banks. You can trade MCX futures if you want leverage and liquidity, though be very careful with position sizing and risk management. You can invest in sovereign gold bonds, which offer both price appreciation and a small interest rate. Each approach has pros and cons, and many investors use a combination. Beyond precious metals, diversification across asset classes and geographies becomes important when financial system stability is in question. Don't have all your wealth in a single country's banking system or currency. Consider holding some assets in different jurisdictions if feasible. Real assets like productive land, tools, equipment, anything with tangible utility can provide value preservation that paper assets cannot match. Building skills and capabilities that have value in various economic environments is also crucial. If your income depends entirely on a single employer in a vulnerable industry, think about developing alternative income streams or marketable skills that could help you pivot if necessary. Community relationships and networks become more valuable during times of stress. People who can offer valuable goods, services, or knowledge to others tend to fare better than isolated individuals. Finally, stay informed but don't panic. Yes, the warning signs are serious. Yes, a financial crisis is a real possibility. But panicking and making emotional decisions will hurt you more than help you. Have a plan, execute it methodically, and then trust that you've done what you can to prepare. If you found this analysis valuable, please hit that like button and subscribe for daily updates. Comment below and let me know how you're preparing for what's coming. Until next time, stay informed and protect your wealth.